Hello, everyone, and welcome to Volume 1 of MC and the Squirrel with their multi-asset speed date. Right, this is not going to be your regular 3-hour investment podcast. This is speed in the name. We're going to keep this punchy. We've got 20 slides to go through today, and we're going to try and take this as crisply as possible. With me today is MC of Macro Charts. He and I started in the markets together. MC's traded macro on the sell side and the buy side since the early 90s, and I'm really delighted to be doing this with him. MC, anything you
Good
want to
morning,
add?
Squirrel. How are you
Thank
doing
you.
today?
I'm very well. I'm very well. I'm supposed to be at the beach and it's pouring with rain. So, what better than to talk markets with you?
I'm all in.
Okay, let's kick it off. 1 minute down. Here we go. Here we go. So, what do we
So,
got here, MC?
well, this caused my attention because right now we have an uptrend in the equity markets in the US. Everybody wants to look at the S&P first, so let's get that out of the way. I think ETF flows are pretty extended here. It remains to be seen if this is a underinvested push higher and with more buyers coming in as we break to new highs, or if this is going to be more like the last buyer has finally put their hard-earned pennies into the market and the market is now going sideways and unable to attract new buyers. So the last buyer has finally capitulated into the uptrend and the narrative of the bull market.
Okay, and we're sort of out of buyback pressure right now. What else? What else are we seeing out there? What about the options market?
Well, VIX is low, all kinds of measures of expected volatility, and put call ratios, any kind of sentiment measure you want to look at looks pretty extended here. And so the question is, can momentum still go anyway? And I would say some areas of the market suggest we're not quite there anymore. So we can
Okay,
move
well
to the
that
next
that
slide.
segues neatly onto the stocks, right? Because this has
Exactly.
been our leadership year, well, for the last 18 months, frankly.
Exactly. So just to keep it really simple here, we the pure semiconductors SOX chart, which everybody's looking at, it's still in an uptrend. It's still holding the 200-day moving average, but the relative ratio not so much. This is a very clear loss in momentum after a torrid year and a half rally in which the semis were the undisputed AI leaders of the bull market. And so the question now is, do you invest in something that has relative momentum in a downtrend? And is this now the end of the cycle? And, I would ask the trillion-dollar question, which is, semiconductors up until about 2 years ago, throughout their entire history, were probably one of the most cyclical areas of the market. Have they stopped being cyclical because AI is now the new paradigm, or are we in for another down cycle or some kind of repricing?
I don't know. I cut my teeth as a young banker, refinancing and recapitalizing all the DRAM players in the early 2000s. If the semiconductor industry has truly changed, I'd be really surprised. I saw that yesterday. Nvidia had a very strong day just off the back of the fact that Jensen Huang had said that he'd sold enough for now. Um, Insider selling's been quite a theme that you and I have discussed over the last few weeks. I mean, I mean, I think there's less information value in insider sales versus insider purchases, but I think it's instructive that S&P management teams have been selling stock like it's going out of fashion this year.
Agree, especially around the middle of the year, right as the equity indexes were topping.
Yeah, and I'm going to skip on to the next slide because I think that you've talked about ETF flows in the earlier slide, but I think it's underestimated just how important the role of foreign institutional money is well, foreign money period has been in the US equity markets over the last few years. And it's a trend that's, and I borrowed a couple of slides here. By the way, everyone that's on both of MC and my distribution will get a PDF of the chart deck in case you're following along on a podcast. But I've taken a couple of slides here, one from Gavakal and one from Joseph Wang, the Fed guy. just showing how foreign flows into US equities and US assets generally have been so significant over the last few years. I mean, it didn't escape my notice that, yeah, while we had a decent week last week with the rate cut, many other equity markets elsewhere in the world had much better weeks. And particularly if you're thinking in terms, and we can talk about China a bit more specifically later, but I have a feeling that there's a great deal of Asian money that's been hanging out in the Nasdaq in the last couple of years. And Asian investors are trend followers, and the trend has been very strong with their friend. If trends are emerging, closer to home, I think we could see those flows get a bit more domestic. Any thoughts there?
Yeah, I agree. This idea of US-led dominance, as far as the eye can see, at some point you're going to get a reversal. At some point, Asia will be a source, an engine of growth, possibly with this China news this week. Little by little, the challenges to keeping this tech hamster wheel going at these valuation levels. Even, eventually something has to break. Eventually, investors get disappointed. A lot has been priced in. So I think the bar's been set really low outside of the US for outperformance. We just need to get earnings picking up, and I think investors will follow.
I agree. I agree. Well, I think one of the reasons that we decided to get going with this call last week was you and I talking about the rotation trade, right? And you put out a great piece
Absolutely.
last Thursday around cyclicals and defenses. It also happened to be what I wrote about this weekend. Two great minds think alike and all that. But I mean, I'm really clocking this massive camping out in defensive equities as everyone thought that there was an economic downturn ahead. Do you want to walk through this slide here,
Yeah,
MC?
absolutely. We've been going through these oscillations now for what, 2-3 years, where every 6 months, the market thinks we're going into recession, and the other 6 months, we're back to inflation. That's just what's been happening. And I think it's fascinating. Right here, and I've been on the camp for lower yields since right around June, and we've had a massive move lower in yields. And similarly, we've had, if you look at the way that I'm looking at in this chart, is essentially a net. So I'll take, the S&P has 11 sectors. I'll take the 5-6 cyclical sectors, and I'll add up the flows of the ETFs that track those sectors, all of them, and then I subtract the flows from the defenses, for instance, utility staples, which have been on a massive run this year.
Yeah.
And to me,
And
it's
I mean,
mind blowing.
I've just clicked it over to the B of A survey, which is a
Yeah,
similar exercise there. I think both of us
exactly.
have used this chart.
And both charts come to a pretty similar conclusion. And to me, it's mind boggling that the flows have now reached sort of similar levels to when the world was shut down from COVID in the first quarter
Yeah.
of 2020.
It's kind of insane, and I actually think that and we'll talk about this in a second, but I actually think that the traditional defensive sectors are no way as defensive as they used to be. I'll talk about that in a second. I mean,
I
I
agree.
did a similar exercise just looking at sort of year to date returns for an equal weighted defensive basket of XLU utilities, XLP consumer staples, and XLV healthcare
Hmm.
versus an equal weighted basket of mining, XLB materials, we'll talk about that later, XLE energy, and XLI industrials. Now, the defensives, and this was through to Friday's close, so we've had a bit of action since then. The defensives were up 19.25% on the year. The cyclicals, 800 basis points back of that. But if you just wanted to look at utilities alone, you could tack on an extra 1,000 basis points of outperformance by the
Mm-hmm.
utils as they started to get this identity crisis around the artificial intelligence trade. I mean, if you look at these sectors from a valuation perspective now, staples, utils, and healthcare all trading at very, very racy premium to long-term historic sort of forward EV/EBITDA multiples. And, that just looks very stretched for me. When I think about healthcare, you've got a coin toss election in front of us where, healthcare is going to be a political football. That's not a great time to be in that sector. Um, Staples are looking nosebleed expensive, just as they're facing competition from the likes of Mr. Beast and other sort of direct consumer brands. And then you've got the identity crisis sector of all, which is the utilities. Now, I hear you that some of the independent power players, like the Constellation Energies, like the Vistras, will be able to monetize the hunger for power by our tech overlords. But the rest of the utils are running regulated assets, and they're being caught in the sort of the slipstream of these AI utils, and I think they're just getting to very, very heady valuations, which look, they're begging for a correction, frankly.
I agree 100%. I would also add, we don't have the chart for today's call, but there was a chart I put out in the weekend report that I published on Sunday, showing the XLU in its entire history. So it's the ETF that tracks the utilities, the largest utilities tracking ETF in the US, is now reaching one of the highest long-term overbought readings in the history of the ETF. We've only reached these levels of overbought about 5 times before. All of them led to major tops. So like the last time the utilities were this extended was in late 2019, right before the COVID plunge, to give an example. Other times, 07, etc.
I'm living that particular dream, MC, as I've been short them since May, and it's one of the reasons. I mean, we talked about how they might not have the defensive characteristics from a narrative perspective, but their their characteristics as bond proxies. I mean, I really scratch my head, because I don't think I have no desire to be long duration fixed income here, and that brings us neatly onto the TLT, right, which looks as extended as that utilities chart you were talking about.
100%. It's all the same trade, right? We have super extended defensives in every way, and the quintessential defensive asset, right? The long end of the curve. We've had the largest, most epic buying spree in the history of that ETF, the TLT. But let's move on to the next.
On this slide here, I've got the shares outstanding at TLT is a good proxy for retail inflows. I think everyone's been reading a bit of financial history and thinks they're going to be the next Paul Tudor Jones by being long duration treasuries when the market corrects. But they got their first Fed cut last week, and it was a big one. And what did TLT do on the day? Right. I think there's going to be a lot of disappointment out there from that very crowded position in long duration fixed income. A lot of disappointment.
Yeah, absolutely. How much pain could these investors see, even if we have a 30, 40, 50 basis points backup in the curve? I mean, that would be normal bounce in a downtrend. What if it's something more?
And a lot of them are chasing with options as well. So right, and they're decaying. We've seen a massive compression in Treasury volatility as well, right?
Exactly. I really like your next slide, also, by the way, on the XLB.
Oh yeah, well, yeah. So I was pitching the XLB. I mean, you remember the great line from the Graduate when Benjamin's brought out to the patio in the Pasadena drinks party, and the guy walks up to him. His dad's friend goes, "Just one word: plastics." I mean, I just think that basic materials, right? What if we are, back in the early noughties again, and we are potentially looking at, a massive outperformance of basic materials and alongside the cyclicals, but grubby chemicals, packaging, copper miners, and that's what the XLB is. And I think it's been just a gentle leak out versus the market since the GFC, but it's that first decade of the millennium that interests me, and I think it's a distinct possibility.
Yeah, I agree. If one is arguing that we're at a technological jump in the world and a new phase of growth driven by new technologies and all kinds of new industries that are just beginning, this is the driver.
And a need for more power stations to be built and the infrastructure around this
100%.
great tech revolution. I mean, if you just look at where the XLB is just valued relative to history, I mean, long-term multiple of around 11 times forward EV/EBITDA. We're trading a little bit north of that right now, but just look at the discount versus the broader market. And this is for a category of companies that are going to grow, compound their EBITDA growth over the next 3 years per consensus at double digits, right? I just think that looks like, rock solid value here.
Right. And can you say the same, about some of the larger tech behemoths
No, you
sustaining
really
that kind of
can't.
growth?
I
Probably
think
not.
these guys are investing for existential reasons right now. They can't afford not to be owning the God computer as and when and if it comes. And so, this capex is non-discretionary from them. Yeah, I mean that's great news for Jensen and his cousin, but I'm not sure it's great news for the shareholders of the hyperscalers. But anyway, I wanted to bring my technical guru in to have a look at the XLB chart itself. This is your daily chart, right?
Yeah, this is just a standard. And by the way, the monthly and the weekly are all confirming. This is just a standard breakout. You know, took a
Yeah.
while, but this is a nice base breakout. This could target all the way to 100, 110 over the next few months. It
Well, what
really
I would
looks like the
say is,
potential for a leading sector here.
yeah, I agree. And what I would say for people that do believe in these kind of things, have a look at the weekly chart on and slap on some Bollinger Bands and some Keltner channels. It looks to me like this thing's been squeezing on the weekly chart
Hmm.
for quite some time right now. And that, I
Absolutely.
put that in my note last week, but it's definitely worth having a look. I just didn't have time to put it into this pack.
Yeah, and so just to elaborate to some listeners that may be new to this concept, what's a squeeze is, what we call a coil or a consolidation move that then expands into a new trend, and that's when you get really some of the biggest moves, fastest moves, strongest gains, um, from a compression coming out of it, leading to an expansion. Very classic kind of trade style, trend trading style, is to look for those expansion opportunities.
I agree. I like the look of this trade from a technical and from a fundamental perspective. And if we are doing this cyclicals rotation, I think this is one of the, like, listen, we'll talk about energy in a sector, but I
Hmm.
mean, energy in emerging markets is also a place where we both love to play. But I think in terms of a US sector that I've really got my eye on here, it's these materials.
100%. But for me, I'm always the energy guy, right? I mean,
Well, right on
for
cue,
me,
buddy. Here's your Brent
yeah,
chart.
yeah. I mean, for me, first of all, just to preface this chart, you know, um, oil dropped $20 a barrel since the summer, and at the time, I was pretty negative. Initially, in the first half of the year, I was constructive on energy, but then the summer came around. I got pretty negative because my momentum signals were fading. And rallies kept getting smaller and smaller, and bounces kept getting smaller and smaller, and the momentum was gradually turning negative. And I just thought, well, this is better to be avoided. And thankfully, I avoided a $20 sell-off, a little bit over 20% decline in about 7, 8 weeks. And on September 11, I wrote a piece where to me, oil had reached a pretty significant oversold reading, and positioning had finally reached sort of like my levels of, okay, this is bombed out way beyond what's justified by the fundamentals and of the market, and so it's primarily a financially driven sell-off, and just began looking for energy as a trade. Initially thought, well, this is a trade, right? This is just an oversold bounce. Maybe we have $5, $10 a barrel higher. But now I'm starting to think, well, there's probably something bigger in play now. This may have been arguably a massive, possibly multi-month, if not a multi-year bottom in oil. We'll see. It's going to depend on China, obviously. Now that we have China news, just a few weeks after that bottom. Um,
Yeah,
but
well, apparently
coming
that
into that low, yeah, go ahead.
apparently their trucks don't drink diesel anymore.
Yeah,
We'll see.
exactly. So just pretty self-explanatory charts positioning. Whether you look at Brent or WTI or gasoline or diesel, positioning is at near the lows or absolute extreme low of the historical range. And I think it's completely unsustainable. This is another example of traders and market flows latching onto a slowdown, global slowdown narrative that I think is just not warranted or justified at this time.
I think that's interesting. I mean, I have not been mucking around at the front end of the crude curve recently. It's been a bad habit of mine in the past. But my energy exposure really has been through some
Long
alternative
dated.
energy equities. So yeah, well, on the equity side, offshore services, and also this year the U.S. refiners, which has been a pretty painful round trip after a really stellar Q1. But during the summer, I wrote a piece about I'm constantly in the hunt for replacements for treasuries as the portfolio ballast, and I made a strategic allocation to trend early in the year, and in the summer, I allocated a portion of what would have been bonds in my retirement portfolio to long dated crude contracts. I think that these are going to capture inflation that's in the system over time. And you're going to do that with one significantly reduced drawdown versus the front month. So on the chart here, you've got WTI out 60 months, 36 months, 48 months, and the second month, right? And you can just see a very different drawdown profile for the longer dated contracts versus the shorter dated contracts. And what's quite interesting for me, and turning the page here, just looking at a very long dated correlation between 36-month WTI and the S&P. Basically, you've got inverse correlation. So you've got that inverse correlation that you were looking for traditionally in the 60-40 portfolio with treasuries, but you get that in all regimes pretty much outside of the most recent recessions where you've seen correlations tick positive. But I really like this as another alternative as a portfolio diversifier for longer term holds.
I think that's a really good idea. And I remember when you first showed it to me, I don't think we're in the world anymore of the 1998 to 2018 to 2019. I think post-COVID and the inflationary structure of the market has shifted, probably for longer than most asset
Yeah.
allocators are ready for. And the idea of 60-40 and bond diversification traditionally as we used to know it, I think that's probably over for now. And commodities serve a much more interesting function as a diversifier than they did
And
before.
I think figuring out ways of owning commodities without paying too much away in terms of roll yields and things like that is going to be a big
Exactly.
part of how I spend my time over the next few years, I'm guessing. Right. Well, let's talk about China because when we planned this call for today, we weren't expecting stimmy action yesterday out of Beijing. And both of us have been making a lot of noise about China.
Hmm.
I've been accused of being a CCP shill on too many occasions over the course of this year. I think that the negativity around Chinese assets has just got crazy. But we definitely sort of coalesced around China in recent weeks, didn't we? And we've been rewarded by this move, which I thought something was possible, but and to be candid, I do hope that down the line something in terms of reforms that touch the real economy a bit more rather than just monetary stimulus would be welcome. But
Agree.
China looks like it wants to move here.
Yeah, and so my history with China here, on the long side, earlier in Q1 of this year, late last year, early Q1 this year, I saw momentum both on the monthly and weekly turn up, which caught my attention immediately. That setup I wrote about in April, when I joined Substack, and I compared it to prior bull market inflection points, for example, like the one we saw in the energy sector in the United States right after the COVID reopening in late 2020, which then led to a 1 year, year and a half insane bull market. This is a classic bear market to bull market signal. and new bull market initiation. I've been of that view since April. Did okay, have been sort of holding on since then, but then gave back all the profits. And I remember right around the August low, after the May to August pullback in FXI and China in general, I remember you wrote a piece, I think it was 3 or 4 days, maybe it was 2 or 3 days after the low, when it was still at the low. And you said, hey, it's time to look at China again.
Yeah,
And
that was
you
the
couldn't have been more spot on
end
there.
of the first week of August. Yeah.
Yeah, and it's just been going ever since. And now, interestingly enough, to me, this chart I think is from the weekend, from
Yeah.
last week, but we were tracking this now for a week and a half, 2 weeks now. This is a classic momentum reset. This is a initial rally followed by pullback, and now you have the sequential sort of. Now you're in an uptrend. This is a classic uptrend now. The longer term charts, I think over the next 6-12 months, you could see I did the analysis in April. Historically, when you finish a bear market, enter a new bull market, you typically recover about half the losses of that bear market within the first 12 months. So if we look at just a simple, that was a 3-year bear market in FXI, a reasonable target would be around the $40 level for this ETF.
Yeah,
Now, is that a forecast? No, it's just that history suggests that that's possible over the next 12 months.
And you know what? Your margin of safety on valuation is just so extreme. So, I mean,
Exactly.
FXI as of last night is trading on 9.3 times forward earnings. Just by way of comparison, India, as in the INDA, is trading on 25.3 times. Sort of EM funds hiding out in anything but China over the last 3 years are all crowded into India. I think a lot of steam could come out of that market as people reestablish normal weight positions in China.
Yeah, I would just add a few on the earnings front. I would just add a few stats that interest me a lot is particularly on Hang Seng H shares, which you basically have the exposure via the FXI as a proxy. So earnings estimates and both projected and delivered have already begun to tick
They've
up.
started quite
Chinese.
enough. Yeah, I wrote about
number
that
one.
in August. It's really, I mean,
Exactly.
it's meaningful. And I do think
Absolutely.
I do think that a lot of Chinese money has been hanging out in the Nasdaq instead of
Yes.
its own risk assets. And I think there's a ton of that stuff that can come home. If you look at
I agree.
if you look at the balance of payments numbers around China, there's a lot of there's a lot of exporter money that's sitting offshore in non-Chinese assets right now. If this market starts to trend, Asian investors are trend followers, the money's going to come home. I'm absolutely convinced.
100%. I would also
Comment
add.
on the currency,
Sorry, go
MC.
ahead.
I mean, I, you know, for me, I've had a couple of side bets of 6 handle before 8 handle on dollar CNH. We're tantalizingly close today, and it feels like a minority position, but it looks like it's trying to push for it now.
Yeah, absolutely. This is a significant breakdown. I think eventually we'll see, well into the mid to low sixes. If this is a multi-month top that's now completed, the potential for a major decline is significant. That is another way to visualize exactly what you said, which is, hey, you want appreciation is capital going back to China from wherever it was elsewhere, either chasing assets higher or stocks higher, or just coming back to something that's working more than the Nasdaq.
Yeah. And what about good old Dr. Copper if we're talking about China proxies? I know it's something you've
So
been
this
following
caught my
closely.
attention. Yeah, so this caught my attention the last couple of weeks. This is another classic situation from a chart level perspective where you have a breakout, which did not, you don't expect it to stick. You do expect that breakout to fail. And I was on the failure camp when we broke through 500 there and everybody was bowled up.
Yeah.
And sure enough, we've given a lot of that back, right back to the trend moving averages, and now we've reset the momentum, and now we're very close to triggering a new buy signal. And to me, this is where you've really and positioning has been cleared out pretty significantly, not extremely, but significantly. And so,
what sort of levels are you looking for on the daily and the weekly to confirm this new trend?
I mean, we're already much higher now this week than that chart, but I think we're pretty much confirmed. I mean,
Right.
we're on the cusp of a buy here. You know, we're all, for all intents and purposes, this is a confirmed buy signal as of today.
Yeah.
And I think probably leads to an extension of at least 6 months, if not 12 months. You know, historically, you know, when this happened, you saw, you know, anywhere between 30 and 50% higher on copper over the next 6 months plus. You know, there is a wide range of outcomes, but all generally bullish and quite bullish from a trend perspective. One of those things where you just want to sort of.
Do you think the curse of Jeff Curry is firmly behind us?
I do, exactly. That's exactly right. I mean, I think he's great, you know,
Yeah, so
but
do I.
when they call him onto podcasts and he says it's the best trade of
Yeah, I
the
know.
career. I mean, look, he's a long-term thinker. And, you know, when the general masses, you know, when you have a great high quality long-term thinker and then the general masses latch onto him and put him on the podcast circuit, that's usually a top, right?
Yeah, it reminds me of the
But I
life
think
of
we've
Brian.
reset that.
He had a messianic moment. No, he's not. He's a very naughty boy. Excellent.
Great
Well,
movie.
listen, in terms of China proxies, these European luxury stocks have just been murdered, right? I put on a trade early summer where I was long Uberlux. So the category of sort of the 0.01% consumption. So Ferraris and Hermes Kelly bags. Whereas stocks like LVMH and your LVMH handbags, I'm afraid, are also Lux, and also Lux has just been crippled in this China downdraft this past year. But I had a short LVMH position on against my long Exor, which is the Agnelli holding company that owns 45% of Ferrari. I took off my LVMH hedge yesterday. I think this thing could be back up at 740 in a heartbeat.
Yeah, exactly. That'd be a 50% recovery of the losses. That could be a 3 6 month trade.
Yeah, I think that purple 200-day line looks like a first objective for me.
Yeah, if the China story has legs and the Chinese consumer, you know, goes from absolute black bearish end of the world sentiment levels to, hey, things are getting better, I think that's a pretty good objective on the chart.
Yeah. I mean, so just in terms of China moves today, obviously we haven't got the exuberance that we had yesterday, but it still looks pretty constructive. I mean, Baba has been sort of in the Hong Kong dollar line has been struggling with unch all day, but that's actually not really a seasoned security yet. I mean, the local listings really only just had eligibility for the southbound connect. And so, I mean, I think it's just a little bit of noise, but otherwise, sort of more seasoned names are continuing to power on ahead today.
Yeah, and you know, just on a very short term, very not my style, but on a very short term tactical time frame, you know, Hang Seng HSI index is now hitting almost an 80 RSI at one
Yeah,
point intraday and is now backing off a little bit from the prior high and earlier this year. Okay, that's normal. Maybe we get a breakout and then followed by some kind of a consolidation and sort of reset the momentum for the next leg higher. But what I'm getting at here is, you know, don't have the mentality that this is sort of, you know, a flash in the pan and we're going to go back, you know,
yeah. I'm
to a bear
getting a
market.
lot
I
of
think this is a
chatter that
big
people
change.
are getting a lot of chatter that people are sort of banking their sort of 2 week calls and thinking that it's
Yeah,
just a sort of classic stimmy response and it'll be back down again before you've blinked. I think this move's real.
I agree. I agree 100% from and that's confirmed by multiple trend indicators that I follow on all time frames. This is potentially a classic bull market initiation or secondary leg of the bull market now underway. And, you want to be disciplined about it. You don't want to get euphoric about it, but, there are ways to manage exposure and buy on dips and look for resets. I'll try to, I'll be updating that as we go. I think there will be opportunities to add capital to it. There's no need to be fully engaged here. But I think there will be, this could run if if history is a guide. This could run 6-12 months, maybe longer.
I think all of us felt too light yesterday. But I think, calmer heads prevail. I think it's just going to be such a relief to be talking about something other than the Mag 7, I hope, over the next 6, 12, 18 months.
I hope you're right. The world would be a much more interesting place.
Amen, amen to that, brother.
Did we ever talk about the short interest on FXI? Did we cover the short interest chart on FXI?
We did. I'll get back to the chart. I had it up there. If you wrote, your bull markets are born on pessimism. No, that really was something else.
Yeah, it's just worth updating that chart because I think I shared it in Q1 of this year. But what's fascinating to me is that the short interest has climbed since Q1 of this year systematically. Is now the second highest short interest in the history of the CTF, despite prices going largely sideways.
That's incredible. That's incredible. Anyway, so we've almost fulfilled our promise. I think we've done 35 minutes. We'll get crisper at this, guys. You know where to find us, blindsquirrelmacro.com, and MC, you are at macrocharts.substack.com. You're a bit of a legend on the Twitter. I'm at Squirrel Macro there. You are at Macro Charts there. But you know where to find us. Please spread the word. We're making this version of the speed date free for all of our subscribers. In due course, I think this is something that'll just be for paid subs. But please share it around. There's a copy of the slides that'll be in the email that you receive, a PDF. And you'll be able to listen to an audio version of this on the Squirrel podcast apps. Okay. Anything you want to add, MC? Otherwise, we'll wrap it there.
Would just say it's been a great pleasure, and I hope to do this again soon. Hopefully, if people show interest, and we can get back to we can revisit some of these themes, and maybe we'll have some new ones to talk about in the next time.
Absolutely, I'd love to do that. It's been fun, pal. Till the next.